let's say we do go into a crisis, which I do think is a possibility down the line, and I don't think it's too far away. And there's a number of scenarios I see when that happens. One is called the bail-in, and this is where there is a requirement by the government that some of your money in the bank is lent to the government against your wishes. You're basically told, everybody who's got more than 10,000 lends the excess to the government. When we have central bank digital currencies, to all intents and purposes, we now have two types of money circulating and exchangeable one for one. So you have the money which has been created by the system, by the banks, which is circulating. And in the early stages, for the first few years, you could change your money one for one for the central bank digital currency, which is the liability of the central bank. And then along comes this crisis, and suddenly they say a treasury bond is in the old currency, and we have the new currency, the CBDC, but you can't, as your bond matures, you can't take your bond and move it to your CBDC wallet because of the restrictions, the capital controls on doing this. And now we've got this dual system where the old currency is definitely not worth as much as the new currency. All you've got is a hope that these rules will be lifted and you'll be able to change your old currency into the new currency, because there'll certainly be a promise that you'll be able to do so in the future when the crisis is over. But that moment might never come. You're likely to end up with something which is either worthless or worth a lot less, or has not got the buying power of what you'd get by being in other things. That, I think, is my message. And it could happen in multiple different ways, ranging from that CBDC taking over the old currency through to the bail-in. And of course, there are or hyperinflation or other things. All these things are possibilities. We don't know which one's going to hit us, but we do know that the situation is almost unstoppable to go into a debt spiral at some point. We're getting very, very close to this debt spiral, which can come at the moment when confidence is suddenly lost. And you don't know when or how that happens, but these sort of things have happened in history, and it can come very, very quickly without warning. You just don't know what triggers it. It doesn't matter whether you call it CBDC, stablecoin, or whatever. Effectively, we're moving in the direction of a centrally controlled currency, even if these are private companies which are currently issuers. But the direction of travel will be one where the government effectively takes control of it and says this is the way you'll use your money. If you put the central bank in the hands of the government, there's no doubt that they will do what the government wants, which is basically print money to pay for everything. It's not high on the news, but the Federal Reserve is insolvent. And the reason it's insolvent is because the liabilities exceed the assets. I used to say to my friends, and I'm going back a few years ago, maybe 5 years ago, I used to say, I think as far as the financial system is concerned, we're at 5 minutes to midnight. And they would say, no, it's everything's fine, it's going to go on, you're being over-dramatic, Clive. I said, well, that's how I feel. Anyway, these days I say to my friends, I think we're at 5 minutes to midnight. And they say, no, Clive, you've got it wrong. 3 minutes to midnight now.
What is the name of the soft toy behind you? Because he's on all your YouTube videos. Does he have a name?
Yes. This is in fact...
I'm your host, Farzin Irani. Let's connect the dots. Our guest today is Clive Thompson, a financial expert with over 50 years of experience under his belt. He's a retired wealth manager and private banker from Geneva, Switzerland, boasting a formidable 47-year career in trusts, wealth management, and Swiss private banking, and now a specialist advisor on artificial intelligence and markets. Welcome, Clive. It's such a pleasure to have you on our show.
Well, hello, Farzin, and thank you very much for inviting me.
It's honestly a pleasure, Clive. I've been following you on LinkedIn and a few other channels for a long, long time, and I love what you have to say. And I thought I'd bring you on to have a chat with our audience because they need to hear what you have to say. So what I generally do when I start off these sessions, Clive, is I know who you are. Maybe some of my audience doesn't know who Clive is. So could you just give us a background on your career and where are you up to now?
Well, I've been in wealth management for 47 years until I retired 3 years ago. And I've been investing in stock market and gold actually ever since the age of 18. So that's 50 odd years now. I'm 68 years old now. And since I retired, I've continued what I was always passionate about, which is investing. I mean, I suppose my biggest passion was the stock market, really, because there's so many things out there and there's always opportunities. So I'm working a lot with artificial intelligence and all my theories as well to try and find the way to work faster and produce better and more interesting ideas. And I'm spending literally 8 to 10 hours a day doing that now.
Wow. So you haven't really retired then, have you, Clive?
No, I'm working just as hard as I ever did. I just don't get paid for it anymore.
Well, fair enough. The whole point is you love what you do. And that shows even in your interviews and what you share on LinkedIn. So it's a privilege to have you on our show. Um, to start off things, Clive, what do you think is happening in the global markets, especially what's happened recently with the French government falling, the Japanese prime minister resigning, what's happening in the UK, maybe the global macro picture before we go into the nitty gritty?
Well, on the global macro picture of what the kinds of things we're talking about, obviously the news in France yesterday of the French Prime Minister, he lost the no confidence vote and he will have to be replaced by Mr. Macron. But that does create a situation of uncertainty in France. We've seen today that the yields on 10-year French bonds have risen and they're already about 1% higher than equivalent German bunds in the same currency. Which just shows you that investors are pricing in a different level of risk for French bonds. In other words, they're saying, I'm not as certain that I'll ever get repaid on these as I am if I buy a German government bond. And it's not just France. I think we got, first of all, this sort of event is not particularly unusual in the world. I mean, in 50 years of investing, there's never a week or a month or a year when you don't have multiple events where you can try and look at it and say, now this tells us the entire future of mankind. But none of them actually do. They're little events which you can add together to perhaps get some sort of future, but individually they don't really tell you very much except what's going to happen tomorrow and for the next few days, and then it's already happened and it's too late to do anything about it. But I think if I took the big picture here, we've gone into a world where uncertainty is increasing. And I think that's particularly true with regard to the United States, which was always, all my career, regarded as a nice, steady hand. You kind of knew where you stood from today, tomorrow, next year with regard to US assets. I mean, they might go up or down, but at least you understood that there wasn't going to be a great deal which could change in the regime, which might move them. But I think today, and for the last 6 months, we've got this situation where surprises are coming out of the woodwork almost daily, and we don't know what to expect tomorrow. And people are getting a bit nervous. They're saying, you know what? The dollar was a nice, steady asset to hold, whether it be equities or bonds or anything in America. And now suddenly I feel this unease that there might be some bit of news tomorrow that I don't like. We're already experiencing foreign governments who are sort of thinking, well, we kind of like to get rid of or reduce our exposures to treasuries, but do we dare? Because if we start to do this, this will be seen as an aggressive act, almost an act of war to sell our treasuries. So we better not do that. But what can we do? So people are saying, I'm kind of feeling perhaps a little trapped. I've got these dollars, but I don't really want them. What can I do? And so this is why things like the stock market is going up in America and gold, because they're not really the dollar. You're investing in companies, you're investing in gold, and it's kind of an alternative. But not everybody has those options.
No, they don't, because especially if you're an investor overseas, you might not have access to the US markets, right? What is your view on the US markets? Are they overpriced, or do you think they actually seem to be reasonably priced given what's happening in the European countries? Because as you explained, I think capital is rushing out of European countries and into the US stock market. Do you see it that way?
I find the prices relatively high, and I've seen some people saying as high as it was in the dot-com bubble. I don't think that's true myself, but I've seen from reputable sources. I think I saw one from Bloomberg the other day, if I'm not mistaken, saying it was at dot-com bubble levels. I don't think that's true. And when prices are relatively high, I'm talking about measured by normal parameters such as the price-earnings ratio. It doesn't mean to say they can't continue going higher for very, very long periods of time. My best example of that would be 1994, when prices looked rather stretched. And then we had another, at least as far as Wall Street's concerned, another 7-year bull market after that high point, when stocks went up another 200 or 300% in 7 years. So at the end of the day, overpriced doesn't tell you that you should sell because it might go down tomorrow. What it does tell you is if you have assets to allocate and you can find something cheaper with the same prospects, you might want to buy the cheaper asset. But a wholesale liquidation of assets to go into cash, I think, is a very dangerous thing to do.
Fair enough. The reason I asked you that question, obviously, as you said, you've got to compare a couple of things, right? There's all this global capital. It has to go somewhere. So as you said, it might look on a graph like it's reaching new highs, but global capital has to go somewhere. And I've heard you say in your previous interviews, and obviously on LinkedIn, you agree with my concept on this, that government bonds are kind of a no-go zone. Care to explain the reasoning and the logic behind that?
Well, I think that if I buy let's talk about a 30-year bond, but I think this can apply equally well to a 10-year bond. If I buy a 30-year bond from most Western governments, I have almost no confidence that I'm going to get paid in something which will buy me something as useful as I can buy with the same money today. And what do I mean by useful? I don't necessarily mean frozen pizzas. I mean, I'm talking about the sort of luxuries one wants to have when you're in retirement, whether it be cruises or medical care or a nice retirement home or a lovely house by the sea or a golf course or private golf lessons or a masseur. All these things that one might expect to have as you get into retirement and you're saving up for your retirement. They're the kind of things which are currently in limited supply and will remain in limited supply, and therefore by the time you get replayed, the supply isn't going to have gone up a lot, but the amount of government bonds and cash on the planet will have gone up many, many multiples, if indeed you get paid at all. But let's assume best case scenario, you get paid in heavily deflated, devalued currency. It's not going to buy the same amount of all those things that I can buy today with the same money. So in that respect, I don't think it's a very good savings place. Now, it would be if the interest you could earn exceeded the inflation of its own rate of growth. But the fact is, you only have to look at, let's take the United States. It's not terribly different around the world. You take the United States, you take the rate of growth in the government debt, it's about 7% a year. And that is set to increase as a rate of growth. And you're not being paid or earning anything like 7%. And then if you knock off your taxes, you're much worse off. Anyway, so you're going, even before taxes, you're going backwards because they're expanding this debt year after year after year by a much faster pace than you're being paid to keep that debt. So I wouldn't be keeping it myself. I would be rather bailing out of it and trying to find something else. But not a lot of people, not everybody has that choice. I mean, if you're a pension fund, you're more or less obligated to match your liabilities with your assets with your liabilities, and that does require a certain level of government bonds, even if they're a particularly bad deal for your pensioners.
Yeah, you're right. Not just pensioners, insurance companies, some wealth funds, they're actually mandated and forced to own government bonds because the logic is government bonds are the safest asset. I've worked in banking for 20 years, and government bonds or the government is seen as a AAA rating, even when we're credit risk rating a sovereign compared to even an Apple or a big organization. The governments are seen as what do you call it? Risk-free return, they call
Yep.
it. And now market commentators call it return-free risk because obviously, as you explained, if you're getting a 3% return and the rate of inflation 7%, you're going backwards by 4%. Plus, you then have to pay a tax on it. So essentially, you're only just walking a treadmill, in fact, going backwards. So do you care to explain that your view on what governments could actually do, or do you think governments will default?
Well, the line is that most Western governments print their own currency, albeit it's by an independent central bank, and therefore, in theory, they cannot default because they can just print, and they can print until the currency is worthless, but they cannot default. At least that's the conventional view. But there obviously is the sort of default by high inflation, and there are several other things which may happen. The first would be a level of taxation, which makes it basically 100% tax on everything you get, or something extreme like that. Obviously, this would be very extreme, and I'm not expecting that to happen. But I'll tell you what I do think is a probability. And I think this is something which is pretty much on the cards down the line. I think there's two things. First of all, what the government would like and what they might be forced into doing. So what they'd like is to keep kicking the can down the road, keep printing the money and hoping that the retail prices don't explode. And hopefully that won't happen because we've got robots making everything you consume is made by robots, and there's almost an infinite supply. So when I did economics at school, after school, we had two types of inflation. There was the cost pull inflation, where you have cost push inflation, where you have the costs going up and it pushes up the prices. And then you have demand pull, where the demand is so high and there aren't enough goods to go around, you pull up the prices. Well, that demand pull inflation's gone out the window. There is no demand pull inflation because it doesn't matter how much money you've got. You can buy an infinite number of pizzas. You can buy an infinite number of any item you like because they'll just expand the production to meet the demand. So it's not like the old days where all these things were squeezed. But of course, you do have demand pull inflation in the supply of limited things. Limited things would be a nice house by the sea, for example, or a cruise. Those are limited supply items. So as the money on the planet goes up, you're pulling up the prices there. But for the most part, you're not pulling up the prices, but you do have to some extent cost push. But the more and more we bring in automation and robotization and digital services such as Netflix, for example, you can supply 100 million people with a movie or 1 billion people with a movie. It doesn't cost any extra. So we're now in this world where for the cost push, it's only a limited component of everything which is produced. It's the human element, the transportation, the marketing, but the manufacturing of most things is now very much by robots, and that will continue, and it will continue to get cheaper and better. So I don't see a huge amount of inflation at the consumer price index level, but let's assume that the government believes that, and that we'll continue to have this ongoing borrowing, spending beyond their means. And now this could at some point spiral out of control, but the hope by the government is that they can stop that by having the central bank step in at a certain point as lender of the last resort and buying the bonds that the government needs to issue because it needs to borrow money. And, they hope that they can keep the game going at least until someone else's problem when they've retired. But let's say we do go into a crisis, which I do think is a possibility down the line, and I don't think it's too far away. And there's a number of scenarios I see when that happens. One is called the bail-in, and this is where there is a requirement by the government that some of your money in the bank is lent to the government against your wishes. You're basically told, everybody who's got more than 10,000 lends the excess to the government, depending on whether you're a company or a person. There's some rules, but everyone lends the excess to the government, and you're lending it to us for 30 years at 0.5%. So it sounds like an asset, but actually it's pretty worthless. That's a bail-in. The other possibility I see is if and when we get to the digital currency stage, and I'm talking here central bank digital currencies, which I think is coming. When we have central bank digital currencies, to all intents and purposes, we now have two types of money circulating and exchangeable one for one. So you have the money which has been created by the system, by the banks, which is circulating. And in the early stages, for the first few years, you can change your money one for one for the central bank digital currency, which is the liability of the central bank. And then along comes this crisis, and suddenly they say, because we're in a crisis and the shops are all empty of all the stuff that people need, and it doesn't matter what the crisis is, it could be a war, it could be civil unrest, it could be a natural disaster. Because of the crisis, we're going to impose restrictions on what people can buy. So the only way you can spend your money is via the central bank digital currency, and there'll be limitations on how much you can put into the CBDC for the purposes of A, B, C, and D, and anything in excess will need permission, or it's postponed, or it's delayed, or it's temporary. You can't move the rest of your money into the CBDC, so you can't do anything except what you've got in the CBDC wallet. And that effectively then creates us a system where we have two currencies. The old currency, which the government has its liabilities in, and an Apple bond is in the old currency. A treasury bond is in the old currency. And we have the new currency, the CBDC, but you can't, as your bond matures, you can't take your bond and move it to your CBDC wallet because of the restrictions, the capital controls on doing this. And now we've got this dual system where the old currency is definitely not worth as much as the new currency. All you've got is a hope that these rules will be lifted and you'll be able to change your old currency into the new currency, because there'll suddenly be a promise that you'll be able to do so in the future when the crisis is over. But that moment might never come, in which case your old currency becomes effectively a defunct currency. The government doesn't default on the old currency because it can still keep paying in what is now effectively worthless paper, but that worthless paper can't affect the economy because you're not allowed to spend it. So the government effectively has changed its system through the back door without defaulting into a system where it's got a new currency operating, and it can now borrow in the new currency with a debt to GDP ratio in the new currency starting off at zero, and they'll have lots of leeway to reimburse all the pension funds, the domestic pension funds, not the foreign ones. They'll be able to reimburse all the domestic pension funds which are invested in government bonds to some extent. They'll be able to reimburse all kinds of situations. They'll be able to bring in a universal basic income, but their debt to GDP ratio won't rise very much at all. It'd be way below the 100% that they got now with the old currency. So they're leaving behind the old debt and starting afresh, reimbursing who they think deserves to be reimbursed. But the vast majority of holders of dollars, and it could be euros or pounds or New Zealand dollars or Australian dollars, doesn't matter where you are, the vast majority are left behind effectively the defunct currency. And if you happen to be one of the unlucky ones, and who's the unlucky ones? The unlucky ones are the ones with a large amount of money, maybe millions in a money market fund, or lots of bonds, or a bond fund, or who perhaps are members of or members of a pension fund which is invested in foreign assets. Those foreign assets, like a bond fund which is invested in US government or dollar-denominated assets and hedged back to your domestic currency, well, sorry, you've lost it, because they're not there's going to be no compensation for the US government's not going to compensate foreigners, and the British government's not going to compensate foreigners, and so forth. So those who've invested in overseas fiat assets will quite possibly find them untradeable or effectively worthless. So this is a scenario. It's not the only scenario, by the way. I just want to put it out there that there are some scenarios I foresee which may happen. And the reason I mentioned that one is it would be very beneficial to the government, because it's a kind of debt jubilee where they start from zero, they can spend a lot of money. And of course, companies around the world which have borrowed money, all their bonds are left in the defunct currency. And what does that mean? It means they become much less burdened with debt, which means they can now build more factories, do more things because they're less burdened by a debt, or they have a debt, but it's now in a currency which is, to all intents, worthless. So it could be very beneficial for the world. So it is one of those things which will be considered, but it doesn't. I want to stress, I'm not saying this is the future. What I can tell you is the future. The future is this: if you own cash, money market funds, deposits, bonds, government bonds, or corporate bonds, you're likely to end up with something which is either worthless or worth a lot less or has not got the buying power of what you'd get by being in other things. That, I think, is my message. And it could happen in multiple different ways, from ranging from that CBDC taking over the old currency through to the bail-in. And of course, there are, or hyperinflation or other things. All these things are possibilities. We don't know which one's going to hit us, but we do know that the situation is almost unstoppable to go into a debt spiral at some point. We're getting very, very close to this debt spiral, which can come at the moment when confidence is suddenly lost. And you don't know when or how that happens, but these sort of things have happened in history, and it can come very, very quickly without warning. You just don't know what triggers it.
Yeah, Clive, you were just on a roll, so I just let you carry on because you saw so many scenarios and you think exactly like me. You think of all the ways, if we were them, how would we go about getting out of this without getting blamed themselves, right? Because we know governments are collapsing, government debt is collapsing. So let's peel one of these at a time because there were quite a few in there and I'd love to go in deeper, right? Let's talk about the inflation firstly. The way I see it is, as you just said, you explained the pizza thing in there. You said anyone can make more widgets or pizzas. But if there's only so many houses in a country, the inflation actually went into wealth assets. So when governments say, oh, we've been printing all this money for so many years, which is essentially MMT, they saw no inflation, whether it was in Europe or in America, because it was going into wealth assets. So houses were being bid up or stock market was going up and all that kind of stuff. And then came COVID. And in COVID, when they shut down the world, but they still created so much money and handed it out to people, obviously that's when we saw the inflation because the supply constraints kicked in. And now they say we can create as much money, there's never been inflation, but the whole world has seen we saw an inflation problem. Now we're just tackling this one right now, Clive. So what are your views on when the countries get into the poo-poo? Let's talk this through. Is it something where they just create too much money, which you also touched on there? I think like the countries like Venezuela and stuff, where they just go 1,000 of the old currency is one of the new currency. What I'm trying to get at is obviously other countries have done this in the past. People just need to understand history. Countries like Venezuela, say 1,000 or 10,000 of the old currency is only going to be one of the new currency. As you indicated in there, governments can do that. I know I have family in India. I was actually raised in India, and the prime minister just comes on the news one day and definitely cancels the currency as well. Calls it demonetization because it's the black economy he's trying to stop. So they can turn us to CBDC in so many different ways. If they do that, do you think people will actually, again, not everyone's awake. We are in the financial industry and we are awake to what is happening. Do you think the average person will understand CBDC is not good for them?
I think they will. So it'll be a mixed bag. I mean, obviously there'll be plenty of opposition to it, but I think at the end of the day, the man in the street, and including you and I fear, will end up saying, "Well, it's easy to use. It's on my wallet, and we'll just start using it." I think, despite the opposition, we oppose a lot of things that we actually use on a daily basis, don't we? From think of the average parent and his child with the phone. The parent's on the phone all day long, and then saying it to his child, he can't be. So we've got this dilemma. So I think we're going to oppose it, yes, but I think we're going to use it. That's the reality here.
And we might have no choice either, right? We might not have a choice because, as you said, they might cancel the old currency off.
I'm absolutely convinced that despite the promises that they will keep the currency the way it is, the day will come when they say all transactions must be via a government central bank CBDC wallet, and we need that to happen because we can monitor you for anti-money laundering, for tax evasion, and for terrorism. And only by having everything passing through a central point, the CBDC wallet, can we monitor these things properly, because we can't rely on the banks or the individuals or the shops or whatever else to do all this for us. So we have to have a central way of keeping tabs on everything. As every transaction will have a code of some sort saying what it is, and they'll be monitoring for all kinds of anomalies, they say. But of course, it does mean that we've fallen into a situation where you can't actually use any other form of money because it won't be allowed.
And as you said, this is government control. So most people, what I've tried to highlight when I get interviewed overseas as well, is the CBDC is a control grid. problem, reaction, solution. They've had it ready for a long time. They just now need to create the 9/11 kind of event to kind of then say, force us into it, say, see, because it's terrorists or because of this or because of the natural events, that we need to use CBDC. So they've already got it. But just on a couple of interviews back, I was talking to somebody in Switzerland as well. CBDC. We already have BDC. So they already control it through the banking system anyways. That's how they put sanctions or the Canadian truck drivers or anything like that. And in the US, they cannot actually have CBDC, he mentioned as well, because it's in the Constitution that the Federal Reserve cannot go directly to the public. And that's why I think the Genius Act and stablecoin. Do you want to comment on the stablecoin thing? Obviously, it's to do with selling the treasuries as well. But what are your views on stablecoins?
Well, it doesn't matter whether you call it CBDC, stablecoin, or whatever. Effectively, we're moving in the direction of a centrally controlled currency, even if these are private companies which are currently issuers. But the direction of travel will be one where the government effectively takes control of it and says, this is the way you'll use your money. And again, I want to say this is a scenario, because nothing is certain in life, and different countries will operate at different paces and have different rules and in different ways. So I don't want to say that we know the future. And if I say the future, it might well be the future for some countries. It already is for China, right? We already know that it's almost impossible to use paper money in China. And there are plenty of stories around of people who found themselves unable to spend their money on certain things like train tickets or whatever because of...
And just to add to that, Clive, I've just heard something happen yesterday. In Vietnam, they've frozen people's accounts, bank accounts, I think about 86 million accounts, because the banks in Vietnam, the government wants every bank in Vietnam to have every account holder to hand on their digital ID to the banks. And again, the same excuse, we need to know our customer. It could be for drugs, it could be tax evasion, and that just happened in Vietnam. And I think it happened in Bahrain last year, if I'm not mistaken. So it is very easy. Please carry on.
Yeah, I mean, there's the good aspects and the bad aspects of this, but one has to realize that if you happen to be if you happen to be a wealthy person, you've got something which can be taken off you, and once they've got the control of you, it's going to be very easy to take it off you. So poor people will. I mean, I can tell you, I do not think that people who've got no money will have a problem because they're living hand to mouth and the government's going to see them all right. They'll still have their universal basic income or welfare or whatever they get. And if they have some money in the bank, it will be changed to whatever new currency we have. But everybody must have an aspiration and a dream to win the lottery. And even those who've got no money, or maybe they'll have an uncle they never heard of, leave them a huge amount of money. So everyone must have a dream to have a lot more somehow, and therefore they should, even if they think I'm not going to be affected by this, be opposed if they can through the ballot box to the imposition of these sorts of controls via the CBDC or the some sort of enforcement forcing them to use a particular digital currency. I think it's a bad move for the majority, but of course there are the other side benefits that it does cut down on crime and terrorism and all sorts of things which we don't want. So it's a juggling act. Where's the balance? I don't think politicians will, whilst it will start with the good bits, I think they'll gradually move into the control side and take your money.
I think it is control, and the whole banking and the central bank system has been about control since the early 1900s. And I've heard you talk about this. So let's go there, because the CBDC, we could think of 10,000 ways it could be done. What are your views on central banking? Would you care to explain to our audience your views on central banking, arsonist or firefighter, and why are they doing what they're doing? And then we'll go into the governments and the banks as well.
So central banks in general are independent of the government, or they're supposed to be. Now, that isn't always totally the case. We've seen the situation with Turkey where Erdogan fired central bank chairman over and over again because they weren't printing enough money. And eventually that resulted in 40% official inflation in Turkey, and independent watchdogs saying the actual inflation rate, the true inflation rate, was over 100%. And we've now got a situation in the United States where we've got some government interference with the Federal Reserve. We've had one lady who I've forgotten her name now. Yeah, she resigned 5 months before her term was up, possibly in a huff, but we don't know that. But basically, she said, "I'm going to do academic work or something instead of working for being on the board of the Federal Reserve." Then we had this other lady who's been fired by the president, and we've got the president asking Jerome Powell to resign before his term. So you've got this worry about central bank independence in the United States. If you put the central bank in the hands of the government, there's no doubt that they will do what the government wants, which is basically print money to pay for everything. And that basically is a lack of a removal of the checks and balances that we have. Now, it doesn't mean to say the central bank isn't doing that anyway, but at least there's a kind of break on it if you have an independent central bank.
There's a false perception that it's independent, though. They
yes,
still
I mean, they will do it. I mean, my view is they'll do as they're told anyway.
Exactly.
Even if the pretense is not. So the way the central bank, obviously the central bank is the guardian of the money supply, but in times of crisis, when the government needs money and when they can't borrow the money from the public because the public would want a higher rate of interest because the risk is too high, what then happens is the central bank steps into the market and buys the bonds that the government's issuing. So government will issue bonds, maybe Goldman Sachs or someone buys them, and then immediately sells them to the Federal Reserve, making a tiny turn. And so what that effectively does, when the Federal Reserve buy bonds, it has to print the money to do that. So the liability side of the balance sheet of the Federal Reserve is the money they printed electronically, and the asset side of the balance sheet are the bonds they bought. So as they print this money, they're putting it into the hands of whoever sold the bonds to them, whether it be Goldman Sachs, whether it be the public at large, whether it be the Treasury itself. It doesn't really matter what mechanism it is. But by buying bonds and expanding the balance sheet, the amount of money being pushed onto the public at large gets bigger, and that money will find its way into the hands of the money accumulators, the wealthy. Those are the factory owners, the owners of capital, those who can deploy their wealth into other things than just working for money. So, there will be a group of individuals or companies which get richer. And at the end of the day, that money has to find a home. And since they have already, to all intents and purposes, made a decision not to buy treasuries or sold them, they're going to be putting that money into other things, which is why we see the booming asset prices at the moment, because that system has now got to a point where the government, even in a non-emergency situation, which we're not an emergency now, has no choice but to keep borrowing money because it's spending more than it is taking in taxes due to old commitments. And the biggest problem governments around the world are facing, particularly Japan, but it's not immune, America too, the problem is the old debt which they took out during the COVID pandemic and they took out after the 2008 global financial crisis. The old debt is at much lower interest rates than the rates they have to borrow at today. So as this debt is maturing at low interest rates of 1% or less sometimes, or less than 2%, they have to refresh that debt because they can't repay it. They have to borrow more to repay the old debt, borrow from Peter to pay Paul, and they have to borrow at a higher rate. So we've seen, for example, in the United States, the level of interest payments on the national debt rise from 3 years ago when it was 8% of the tax take. So 8% of all the revenue of the government was being consumed in paying interest. Today it's 18%. So 18% of what comes in goes to pay the interest on the debt. That figure, according to, not my numbers, the Congressional Budget Office's numbers, is going to rise. It's going to keep rising. And the Congressional Budget Office have put in their number, in their calculation, a relatively low rate of interest that the government will be paying is about 3.3%. Now, you can't actually borrow money if you're a government at 3.3% today. So there's an assumption that interest rates are going to come down to a much lower level at the long end and at the short end and stay there. It's an unlikely scenario. It might come down at the short end, but at the long end, it's not going to come down that much, in my opinion. It might go up, as it has done when they lowered the interest rates several times already. So the Congressional Budget Office, even as the lower interest rate assumption, is saying the interest on the national debt is destined to keep rising as a percentage of the tax take. And of course, that does mean that if this continues ad infinitum, we get into a situation where the interest would eventually, and it won't be too many years, probably a decade away, is exceeding the totality of the tax take. It's like if you had a family with a credit card and you keep your credit card debt keeps going up every month, and the interest keeps going up, and they keep raising the interest rates on you. Sooner or later, you're not even able to pay the monthly payment. Now, government's not a credit card, not a family with a credit card. It's different. The government can print money, but at the end of the day, this can get into a situation where it's spiraling out of control faster and faster, and we know it's going to break, but we don't know when or how. Now, give you an example. What happens if we go into a recession come depression and the tax take suddenly drops a lot?
Even more.
The interest burden is not going to go down. It's still going to keep going up.
Exactly. There's so many things you mentioned in there, Clive. The whole thing is the government debt is a Ponzi scheme. The governments generally, especially the US government, I don't think has ever paid off its debt. What I've tried to explain to people is they never pay off the debt, they just roll over the debt. And as you mentioned there, debt was cheap after the global financial crisis, because what you said was the central bank was creating more money, which in technical terms, they call it quantitative easing because they're creating more quantity. So they reduced the interest rates. Governments around the world have been borrowing more and more because they could service the debt. Now with inflation and interest rates going up, most governments are struggling. So obviously they want the central banks to reduce interest rates so they can service the debt and not go broke. And as you mentioned, USA with $37 trillion, if the interest rate keeps going up, they have, I think their tax take is close to 4 trillion and they end up a little bit more, I think six, something along there. But I think they're wasting, I would say wasting, because they're paying 1 trillion a quarter in interest or something along those lines. And that is the same spend on defense spending and the social security and all of that, but it's crowding out the necessary stuff just to pay interest. And people who look at geopolitics saying, who's the interest going to? The interest is going to external governments like China and Japan, which is money we could be spending within our country. So on that thing, I think a couple of things you mentioned out there, which the audience might not have picked up, is this could become an exponential function. And within a few years, any government could go broke very quickly. Is that what I heard?
Yes, but in lots of ways. Go
yes,
broke.
of course.
Let's just talk about a couple of things which have been floated. I mean, they're not current ideas, but they've been floated. One was the idea of some sort of tax. Now, it wouldn't be an income tax. I forget what they called it, but a custody tax or a holding tax for holders of government bonds, which would basically mean that if you happen to be a holder of government bond, you'd receive your coupon minus a fee or a charge, not a tax.
Would this be for US citizens as well, or would this only be for overseas?
Well, they were talking mainly about now I can't remember, because this was 9 months old now when this was being discussed or floated. I'd have to go back and look at it, but basically the gist of it was foreign governments were going to end up paying the government for the privilege of holding their government bonds, effectively reducing the burden of interest. But the interest burden would be the same, but they'd be getting something back. Now, legally, they probably can't charge tax on it, but they can charge a fee on the government bonds. That was one idea which was floated. The second idea was and this has been floated as well recently in the last 6 months, to persuade foreign governments that they should exchange some of their government bonds for 100-year gold-backed bonds from the United States. I think this was Judy Shelton's idea. But the gist of it was all these foreign governments should be very grateful for the defense that the United States has offered. And, quid pro quo is you should show your loyalty to us by buying these bonds. But of course, if you I'm not going to comment on whether what they say there is right or wrong, but because obviously everyone's very friendly with the United States for that sort of purposes. But the question is, when your friend leans on you and says, "You're my good friend, and now I want you to buy something you don't really want," you start to say, "Are you still my friend, or are you just using me?" So there's ideas being floated around like that, which probably won't come to fruition. But the point is, things are being discussed, but none of the things which are being discussed are going to end up as good news for the holders of government bonds or fiat-denominated assets in general.
So what you're trying to say is financial repression is coming. The government can change the rules overnight. You might go to sleep on a Friday, wake up Monday, and something's totally different. Is that right?
Yeah, I mean, let me give you a very easy to understand example. Everybody will remember in their lifetime occasions when a queue has formed outside a bank, right? And if it happened to be your bank, what do? Do you sit and wait to see if it's justified, or do you run down to the bank
Run.
just in case? Have you ever been to the I don't know if this happens in America, it happens in Europe all the time. Have you ever heard a rumor that they're running out of toilet rolls or sugar? Well, we get these things from time to time.
It happened during COVID, didn't it?
And suddenly there's a queue outside with everybody buying as many toilet rolls as they can. These things have. I mean, I remember when I was a child, was maybe 10 or 12, and there was in England there was a story about some sugar shortage. Don't know why, and my mother immediately rushed out to the supermarket and came back with a bag of sugar, pleased as hell that she could get one, but she had to queue up for it.
That is it.
I mean, we didn't need the sugar, but it was just the mentality.
But this is it. It's human nature. There's shortages. And as you just said, I think after World Wars, they used to have rationing as well because of this reason. And also, I think in countries like New Zealand, Australia, you could only drive if your car registration number ended with an odd or an even number, you could drive it only on Monday, Wednesdays, and Fridays. So this is where people have, and you've been around for some time, you might have heard these stories from your parents or your grandparents, and that is why you have the memory of what could happen also, right? There's a lot of younger generation investors who have no idea what could happen.
Well, let's talk about Russian coupons. They were issued when I was a child, although in practice they were never actually used. But they issued them we had various emergencies in the 1970s and 60s, which meant the government did issue Russian coupons, but they never got to implement. They were issuing them as a precaution. But before I was born, they had Russian coupons which had to be used when you bought something. So you had Russian coupons for butter, Russian coupons for meat, Russian coupons for this, that, and the other. So when you went to the shop to buy your butter, what was the real money? You might have £1,000 in your wallet, and you had a Russian coupon. Well, it didn't matter how much money you had. If you hadn't got the Russian coupon, you weren't allowed to buy the butter. So what was the real money there?
The Russian coupon. And the government
Exactly.
got to dictate that. That was kind of a communism model as well. And some people actually say that is maybe where the World Economic Forum and stuff want to take us by 2030. I don't know if you want to go down that rabbit hole, or we could just come back to the banking system.
May I just go back to the bit I was talking about, which was the panic about the toilet roll panic, or the petrol panic. You've probably seen it at various points in history, queues forming outside petrol stations where everyone's queuing up because they think we're going to be short of, you call it gas in America, or they call it gas in America. We call it petrol in the UK. Now, what do you call it? You're New Zealand. What do you call it in New Zealand?
Yeah, gas, petrol.
Okay, gas.
Yeah.
We're queuing outside the gas station to get the gas. My point is this: panics can come from nowhere. So when a panic starts, and if it is related to the currency or the money, well, what's going to happen? Everybody's going to rush out with as much as they can spend and buy everything and anything they can buy, which they believe will hold its value. So if you happen to get into a sudden view that there's going to be restrictions of what you're going to do, you can do with your money, and it's going to start in 2 weeks because there's a crisis. Let's take an extreme example. A meteorite has hit the Earth, and all the supply chains are totally disrupted. You can't get your hands on anything. Let's hope that won't happen. But you can imagine something maybe less than that. In such a situation, what are you going to do? You're going to rush out and buy everything and anything you can lay your hands on because you're not sure you'll be able to get it next week.
You're right. And I think even during COVID, some people actually were rushing out and buying booze in Australia because they thought they might not be able to get booze or go to a pub for quite some time. So they were buying booze and bringing it home. Um, but when you said something like that, I want to come back to get people's attention that what we're joking about right now, we can see it playing out in the very near future, right? It could happen within a few weeks. It could happen within a few years. No one knows when it could happen. And the whole point of preparation is before the fact, not after the fact. And there was something else also you mentioned in there, Clive, is it's the wealthy who stand the most to lose because they've indebted so much of the general population. Everyone seems to have debt, whether it's mortgage, credit cards, or cars or holidays and all of that kind of stuff, that the solution that it come up with, 90% of the population is going to gobble it up because they're in debt. And if they can, some people say the Jubilee might be like, okay, you'll own nothing and be happy. So maybe they wipe off everyone's debt, but you can't own any assets on the other end. The 10% who are wealthy are the ones who know that there's a tax grab coming. In fact, just one last bit. I don't know if you've heard about this, but the Australian government is getting that crazy. If you own a 4-bedroom house, Clive, and you and your wife have raised your kids and they've moved out, and you and your wife only live in 1 bedroom, the Australian government wants to tax you on the 3 bedrooms not being used. Can you believe that?
Well, I'm gobsmacked. I mean, this is this is punishment of those who have worked hard and saved all their life, whereas those who have been spendthrift and thrown away their money. And I'm not saying that everybody else in the house was like that, but you can take two sets of people: the ones who saved hard because they've wanted to have that kind of dream house in their retirement, and those who said, screw this, I'll just live off the government in my retirement. It does seem rather unfair, and people will they will think twice about where they live, especially if you're the sort of person who has dreams of making it big one day. When I was young, and I'm sure it's still the case in many countries around the world, many people from many countries dreamed that they would go to America. Why? Because of the land of the free, the land of opportunity, the land where you could make a lot of money, where even the poorest guy could become a multimillionaire if he worked hard and did the right things. But if you have that dream and you're living in a country where you know they're going to take it off you, you're definitely going to leave.
Exactly. And I think UK is losing a lot of billionaires, UK, India, China, and they're all going to the Middle East. Australia has millionaires leaving as well. They're doing brain dead policies, and actually the more authoritarian they're trying to get and the more tax they want, they end up losing more. And they still don't figure it out. Are politicians just brain dead, or, well, should we call them stupid?
Yeah. The evidence that this is still going on is we see that all around the world, schools and universities have a large smattering of people whose parents have sent their kids overseas for education. And where are those kids coming from? From a large extent, they're coming from fairly repressive or socialist-like regimes where they think that it would be good to have a toe in this other country. And if my son's been educated there, he might get to stay there permanently. And if the push comes to the shove, at least he'll be all right. And possibly we'll go and stay with him.
Yeah. It's always a second option. When I worked in banking in Australia, a lot of the Chinese money would go through Hong Kong and then invest in Australia because the kids would come there to study. They'd buy a property for the kid. And that was a way of circumventing the system as well. Capital controls in China to buy properties in countries like Australia and New Zealand. And it gives them a second option. And once the kid becomes a resident or citizen, as you just said, the parent has an option, if required, to migrate as well. And I think that's why also Chinese had blocked Bitcoin because of the capital controls, and people were circumventing that. But just coming back, honestly, Clive, you and I think we could sit down on a 3-hour session and still have things to talk about. But there's too much debt in the world. Governments have taken on that debt. And you said kicking the can down the road. What I saw was the stock market bubble collapsed in 2000. The government created too much cheap money, or the central banks did under Alan Greenspan, created a housing bubble. The housing bubble burst, and then obviously governments took over and the governments took on more debt. Is there a higher level than this? Because I also think central banks themselves are broke. And I've heard you once also mention that. I've tried to explain that when I was interviewed once, that the Reserve Bank of New Zealand itself is broke and its balance sheet is upside down. Do you care to explain to our audience, maybe from a US perspective, why that is the case? And it doesn't seem like anyone seems to talk about it.
Well, it's not high on the news, but the Federal Reserve is insolvent. And the reason it's insolvent is because the liabilities exceed the assets. Now, that doesn't mean insolvent doesn't mean to say bankrupt. So insolvency is just a technical term meaning liabilities exceed assets. But if it was a corporation, like a typical corporation, they might well be and probably would be forced into bankruptcy in such a situation where they liquidate all the assets, pay off the creditors. Now, that's not going to happen to the Federal Reserve because they've got several trillion of. By the way, they're in the. I haven't got the figure that they're in the hole to now. It's in the probably the hundreds of billions, but I haven't got the figure. That's the negative asset. It could be a trillion, but they've got 2 trillion of cash circulating, physical banknotes. Now, those banknotes are never going to come in and say, give us something in exchange. So there's no real danger of everybody queuing up at the front door of the Federal Reserve and saying, give me my money back, and then it can't pay the bills because its assets aren't enough. So the 2 reasons it's gone into this problem are, the first one and the biggest one is all the government bonds which it bought during the pandemic when the interest rates were very low. Now, the price of those government bonds today is a lot less than when they bought them. And the difference is sufficiently huge to already wipe out the capital and reserves of the Federal Reserve, which is only about $40 billion, completely wipe it out. So that's wiped it out in just the decline in value. Now, there's an argument that if these bonds are held to maturity, they'll come back to 100 at maturity. Then they will. So it's not such a big problem.
Yeah, because they don't mark to market. If they don't mark to market,
they're not marked to market. But if they had to sell those bonds, they wouldn't get 100% today because the interest rate is lower than what you can get on an equivalent bond. That's the first reason. The second problem is that, and it's starting to rectify itself gradually, but it's not rectified yet. A couple of years ago, they put the interest rate up from 0, effectively in the United States, to 5%. And what that meant was that all the depositors with the Federal Reserve, which is money market funds and the banks, would earn money market rates of interest, 5%, from the Federal Reserve. But the assets of the Federal Reserve, because that's a liability, they've got a deposit, that's a liability, they've got to pay out the interest. But the asset are the bonds they held, they bought, and these bonds were all paying 1 or 2%, way below what they're paying out. So they were paying out month after month, they were paying out a lot more in interest to the depositors than they were earning from the bond portfolio. So up until when they started putting the interest rate up 2 or 3 years ago, the Federal Reserve every week would pay to the Treasury, the government, its surplus. And it was making a surplus. It was a regular, steady payment of billions every month to the Treasury. But when they went into this situation of raising the interest rates, now they had a deficit. So every month, the deficit gets bigger and bigger and bigger. And that means they'd be making a loss. And the losses become, it only took a few months, so we're now talking years of losses. After a few months, the loss wiped out their capital reserves. But if you look at their balance sheet, you won't see that loss in the profit and loss account. You'll see that loss reported as an asset. Now, you might find that very odd that a loss could be an asset, but I can tell you that is exactly how it's reported on the Federal Reserve's balance sheet. And how is that allowed? Well, it's allowed according to the special accounting rules of the Federal Reserve. So the Federal Reserve has got a set of accounting rules written, by guess who? The Board of Governors of the Federal Reserve. So they
write their own rules, yes.
The accounting to call that loss, that very large loss, call it an asset, or if you like, they call it a negative liability, but it's still is wouldn't be allowed in any normal company. That would be accounting fraud, but they could call it an asset. So if you make a loss, it's a debit, and debit assets are all loss on the profit and loss account. Debits are money going out, and credits are money coming in. But on the asset side and liability side, liabilities are credits, i.e., they're your creditors, and assets are your debitors, the people who owe you money. So they're taking this asset, this item, which should be a debit on the loss as a debit on your profit loss, and stick it onto the asset side of the balance sheet and calling it an asset. Now that makes no sense from an accounting point of view, but if you want to try and rationalize it, the way of looking at it is like this: because this is money that they don't have to pay to the treasury because they haven't got it, they can make that much money in the future and not pay it to the treasury. Therefore, you can call it an asset. It's a bit like in a company making losses, and so it's got tax credits which can be carried forward, and they take those tax credits and call them an asset.
Yes.
Which a buyer might, if you were buying a company with tax credit, you might think you might sort of say, oh, that's an asset to us because we've got profits to offset it. But right now, the Federal Reserve doesn't have any profits to offset against this asset. So, but if they did have profits, then they'd be able to say, we don't have to pay the government because we've got to clear this negative liability or this positive asset because we don't have to pay the government until we've got profits over and above our capital reserves. So in a way, it's sort of psychological saying it could be an asset because it's something you don't have to pay to somebody. I don't have to pay you £100, therefore it's an asset. Nonsense, but
crazy. Clive, I put this in I put this in other terms. Clive, I owe you a rabbit, but I might be able to pull out a rabbit out of my hat. So technically I don't owe you a rabbit. Because the central banks can do whatever they want, whenever they want. They can change the rules of the game. As you said, create money out of thin air. And in New Zealand, I think what most people don't get is, because I'm a New Zealand citizen and I get interviewed on a show called Money Talks in New Zealand, I did some research on this a couple of years back. And during COVID, again, more central banks bought bonds of their governments to create extra liquidity so they could flush the system. Fiscal policy, everyone sit at home. We're just going to give you free money because there's a bad virus out there. Now these bonds have turned upside down because obviously as interest rates have gone up, which is what you were explaining, there's a negative correlation. As interest rates start going up, the bond loses value. And on the Reserve Bank of New Zealand's website, I don't know the exact term, but technically they said that the loss was accumulated based on the government doing this, and the government had to reimburse them, which I also think, if I'm not mistaken, was the Bank of England's policy.
Yeah.
That wasn't it? But the Bank of England also said, hey, too good, we bought it off you, thank you, we helped you out, but now you owe us the money back because we made a loss on the bonds we bought from you.
That happened about 2 years ago in the UK when I don't know what happened in the COVID or global pandemic, the global financial crisis, but I do know about 2 years ago there was a bond crisis. So gilt-edged securities, those the government bonds, were spiraling down in price, and it was causing a major problem for all the UK pension plans, which had these bonds, but more importantly, and maybe sillily, all these pension plans had gone into some sort of special derivative scheme which enhanced their yield, and that was fine as long as the bonds didn't spiral out of control downwards, and that's what's happening. And the more they spiral out of control, the more people had to sell them, and so the Bank of England was invited to step in to save the system by buying these bonds and being buyer of the last resort to stop them from collapsing. And when that happened, the Bank of England said to the government, but we'll only do it if you guarantee our losses. And the government agreed to do that because they had no choice, of course. They couldn't let the entire UK pension system collapse. So they were indeed guaranteed. And I think the government has used billions and billions, I forget how much it is, I don't want to say the number, but it's a lot of taxpayer money to subsequently reimburse the Bank of England.
And it's the bank. So the government actually bailed out the banks again. This time the central bank, during the global financial crisis, what we had were what we called were bailouts, where the government bailed out the normal banks. This time, indirectly, they've bailed out the central banks. And that's what I'm saying. There's nowhere higher to kick this bucket anymore for the governments. It's always the governments and the taxpayer who's on the hook for this. And as you said, lender of last resort and regulator, which is a conflict of interest.
I used to say to my friends, and I'm going back a few years ago, maybe 5 years ago, I used to say, I think, as far as the financial system is concerned, we're at 5 minutes to midnight, and they would say, no, 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 everything's fine, it's going to go on. You're being over dramatic, Clive. I said, well, that's how I feel. Anyway, these days I say to my friends, I think we're at 5 minutes to midnight, and they say, no, no, Clive, you got it wrong. 3 minutes to midnight now.
Yeah, yeah. Now they're on board because they can finally see it. I think most of us, some of us have the ability to see things before the fact, and we're a bit too early. Doesn't mean we're wrong, but we're a bit too early. And obviously, governments have tried to kick the can down the road. I think one of my guests has previously said they've run out of kicks now. There's no way out.
Can I teach give your listeners the benefit of a lesson I learned, a painful lesson?
Yes, please.
Prior to the global financial crisis, I was reading, we didn't have the internet as much as we have it today. I was reading periodicals like The Economist and the Wall Street Journal. And from time to time, there were articles about the craziness in the US housing market and how people who couldn't possibly afford to borrow money were being lent money with no chance of ever being repaid, and how this was creating a very fragile financial system for those banks and institutions which held the mortgages, because it was subprime mortgages. And I sort of shrugged my shoulders and said, so what? And then I went to look at a few financial institutions, and I looked at their credit book, and they, according to the credit book, their average, the ones I looked at anyway, the average credit rating was a certain level of they called it FICO score, FICO. I don't know what that stands for, but the below 600 was dangerous and above 800 was 100% safe. And they said, we got a FICO score amongst all the mortgages we lent is 880 or so, way above the safe level and nowhere near the danger level. So I shrugged myself, you know what, the price of the stock's way down. I can buy it because they haven't done any dodgy lending. How wrong was I not to have listened to those warnings? Because that I'm thinking of one particular company, I've forgotten the name now. That particular company which I invested in, thinking there's no problem because that high FICO score, went bankrupt, along with all the banks and everybody else who was in the same situation. So everybody believed they had a high quality credit book on the mortgages, yet I was being told by reputable financial institutions, journalists in The Economist and other papers, that this is all bollocks. Well, I should have listened to them. So the message to your listeners is listen to the warnings.
Yeah, and especially an investor like yourself who's been in the market for 47 years, also read these reports and trusted them. Wasn't that movie about the global financial crisis that's on Netflix as well, where they talk about this and the S&Ps and the Moody's and the ratings? So obviously the ratings agencies themselves.
Margin call, I think it's called.
The margin call also with the movie with Brad Pitt, it's just slipping me right now, but it was about 2008 global financial crisis, and it shows that there were some smart people who saw it coming, and the regulators still said, no, everything's fine, nothing to see here. Even the central bank governor at the time, I think Alan Greenspan said, US can never have a housing crisis or a collapse, and that's exactly what happened. So sometimes, well, I wouldn't even say sometimes, they lie. Okay, so it is for you to make up your own decisions, for investors to make up their own decisions and make their connect their own dots. But something you mentioned out there, yeah, please, did you want to say something, Clive, in that?
Well, the message is, if you don't know, diversify, so you don't have all the eggs in one basket.
Exactly. We'll go towards that investment thesis for the end times as well, but I just want to cover this last thing because you mentioned the banks in there, and I want people to understand central banks, governments, and the third entity is the actual banks. As you mentioned, what happened, I think banks too big to fail, and as they say, are they too big to jail? Because no one went to jail, none of the bankers went to jail. The government used our taxpayer funds to bail them out. My view on this is the next time there's a collapse in the banking system, there's a bail-in coming. Because when I was in Australia in banking and I saw what happened during the 2013 G20 summit, supposedly most people don't know this, but they signed in bail-in legislation where the next time depositors' monies will be bailed in, which you've also hinted towards. It's happened in Switzerland recently, and it happened during, I think, the Cyprus crisis as well.
Well, not Switzerland. It was Cyprus. It happened. Switzerland. What you're talking about in Switzerland was Credit Suisse.
They write off the shareholder value though on those ones.
Yeah, Credit Suisse had a special type of bond, commonly known as COCOs or contingent convertibles. Had a special type of bonds, and they had shareholders and they had other liabilities. So when Credit Suisse went bankrupt, the owners of the owners of ordinary bonds got paid in full. The depositors got paid in full. The owners of contingent convertible bonds got paid nothing, and the shareholders still got a few pennies on the pound. In fact, they got some shares or something like that. But so they were all right. And then the question is, how could the shareholders rank higher than the bondholders? And there were quite a few hedge funds who decided to sue Switzerland and sue Credit Suisse, now UBS, over that. The thing was, I have no sympathy with those who are suing, because when Credit Suisse was going bust, I thought, it might be a good idea to go and buy some of these bonds. They're yielding 15%, should be a good deal. So as a cautious person, I took the prospectus and had a look at it. And on page 1, in very large letters, and on almost every other page, it said in large black bold type letters, in the event the Swiss government provides any assistance to Credit Suisse, you will lose guaranteed 100% of your money. This is a write-off bond. It's a bond that will go to zero if there's government assistance. And it said it over and over again throughout the prospectus. I thought, you know what? I think the government's going to bail out Credit Suisse. This will be worthless. So I didn't go into it. But all the hedge fund managers, what have they demonstrated to me by suing the government and saying this is unfair, we've been cheated? Well, they're demonstrating to me that either they can't read or they're reckless.
Or they have an inside voice into the government, because didn't that same thing happen with
they can't be paid out? I mean, it's written on the tin, you will not be paid. They still went into this.
They're suing to get paid, aren't they? They might not get paid.
I don't see. I mean, I can't see how in a million years you can get paid on something which says you won't be paid. Now, the situation would be different if this was a retail investor who'd been told by his banker this is as safe as houses, because the retail investor can't be expected to read the prospectus. But if you're a hedge fund investing billions, you're supposed to read and learn what you're investing. I'm only a retail investor, but I read it. If I can read it, they can.
Yeah, but what I'm just trying to get there, Clive, is the reason they're suing is, again, I think there's too many hedge funds that are close up to certain places. And I'll bring up the recent example because it wasn't just this. When we had the US Silicon Valleys and those banks collapse in the US, the same thing happens out there. Is that there's a bail-in legislation, and the FDIC covers you for $250,000, $250,000 US. So on Friday, when Silicon Valley was almost about to go broke and Janet Yellen then has special meetings, the point was, if you had, let's say, 5 million in there, you were only supposed to on Monday get $250,000. But the regulators and the insider governments do have the right to change the rules. Come Monday, they said, no, we're going to cover everyone. So they changed the rules because the big buddies have lots of money in these bank accounts and a lot to lose. Maybe the Swiss government's different.
So obviously this was a slightly different situation because these were depositors. Okay,
yeah,
they were depositors, not shareholders, not bondholders, and they agreed to guarantee all depositors irrespective of amounts. And the reason they did that was the fear of contagion, and this was a very small I mean, it wasn't that small, but it was relatively small in terms of banks. So it was a kind of situation which could be handled in that way by bailing that. Now, if this had been a major, one of the big 5 banks in America, there's no way the government would have had the money to bail them out. But in this particular situation, it made sense to do it because it kind of stopped the contagion. Now, the theory is every bank is now it's not the law, but the theory is that in a similar situation, every bank will be covered for unlimited amounts. We don't know that would happen if it's a big situation, though.
But that's my whole point. They brought into bail-in legislation to say most banks will only be covered for this, And I think in Europe, I don't know what the exact amount is. Is it 100 or 150,000 euros?
Yeah, it's 100,000 euros typically.
Yeah, and when I was in banking in Australia, it was 250,000 Australian dollars. And New Zealand used to have a guarantee, which they secretly took away. And what I've been mentioning recently when I get interviewed is Israel and New Zealand were the two countries who did not have government guarantees on bank deposits till just July this year, when the New Zealand government has finally introduced one for 100,000 New Zealand dollars. And as you just said, who's on the hook again? It sounds like they're going to charge the banks a levy to kind of reimburse the deposit holders. And the levy is so small that they won't even have the funds by 2029. So the government's on the hook. Again, it's always the government. And who's the government? The government is the taxpayer. So essentially, to pay your own money back in deposits, the government's taxing you or taking on more debt. It's a vicious cycle where the average person just has no idea what's going on.
At the end of the day, you've got to be aware that every counterparty you deal with, whether it be a bank or a custodian, there is always a variety of risks which might happen. To give you a very simple example, if you happen to have had assets in Russia, you'll find that they're now frozen. A lot of people didn't see that coming. Of course, they knew there was political risk, but as a Westerner, you can't access your assets in Russia anymore. If you had shares quoted on the London Stock Exchange, which happened to be effectively owning a Russian business, they were frozen.
Yeah.
So that's why you diversify, because even though you think you might have got something in a place where you've got a freedom to buy and sell as you please, the day can come when suddenly they put down the walls and you can't. Let's go back to, I don't know how old you are, but when I was a child and even 18 years old, we had something in the UK called exchange controls. What that meant was that if you travel abroad, you weren't allowed to take more than a certain amount of cash with you. We didn't have credit cards in those days. So you were limited to £50, then they raised it to £100, and then they raised it to £150. That was it. So at the back of as you went abroad, at the back of your passport, they would stamp the money you changed into foreign currency, and you couldn't take more than that.
Isn't that the traveler's checks also was a reason to bring those in?
Yeah, you were limited. There was you were not allowed to keep traveler's checks beyond a certain amount. That was, I remember once in one of the banks I was working for, this is going back 50 odd years ago, a certain person, I won't name him, but let's say an important person at the time had died, and our bank was the executors, and we had to go and empty his safety deposit boxes, or at least document what was in it. And a lot of very interesting things in it, ranging from letters he'd written as a child when he traveled the world and all kinds of things like that. But one of the embarrassments was he had a pile of traveler's checks, which was definitely not allowed because you should have. The law was you had to cash them in. So we had a little bit of trouble persuading and that wasn't me. My boss was involved. I wasn't involved, but eventually the cashier was persuaded to take them back in and get rid of the problem, because obviously they could have vanished into thin air if the bank hadn't cooperated. Now that was those days. I don't think that'd be that easy to do that today.
You'll be surprised.
The owner had evaded exchange control laws.
Hey, Clive, obviously we've been speaking about the banks, central banks, all of that stuff. And back in the 1930s, obviously there was a gold confiscation. And in the 1970s, Richard Nixon came on the news and obviously cut the link between fiat currency and the dollar. As good as gold was not as good as gold anymore. And I know you're a big investor in gold and you've got a lot to say. So please tell us your thesis of what it could do in the future. And what I've even heard one of your forecasts out there, how the central bank or the government in the US could actually remonetize gold with the value of, I won't give it, I won't say it. I want you to tell the audience.
Okay. Well, first of all, nobody should have all their money in gold. You need to be diversified. But I do think the prospects of the gold price continuing upwards, they're pretty good. I think the government, let's just talk about where we've come from. We've come from a long period. We had a long period from 2011 to about 2018, 19, when the gold price did nothing and the stock market went up. And we're now in a situation where gold has been rising for a few years. And I think the reason it's rising is people have this growing level of uncertainty as to what their alternative, treasury bonds, treasury bills, and dollars, will buy them down the line. And they're saying we need to diversify out of that. And particularly central banks are saying it shouldn't be just dollars anymore. It's got to be other things. So I think the gold is well underpinned for the moment. I see some banks starting to put it into their asset allocation. Many banks are still at zero, I'm afraid. So I think the prospects for gold are quite good. I think we will return at some point to some kind of backing in gold for the currency. And this has been already mooted in a few ways. You may have heard if you read the text of the Bitcoin bill, which was an American bill. It's not law yet, and probably won't be law, but the Bitcoin bill had a clause about gold. And basically, the Bitcoin bill said words to one, if I can just give the proper words, it said the Treasury, or rather the Federal Reserve, shall tender its gold certificates to the Treasury, who will then pay them for the value of the gold certificates. That's not a lot of money. I think it's $12 billion or something like that. And immediately afterwards, the Treasury will revalue its gold reserves at the then market value.
Yeah.
And then, immediately after that, reissue new gold certificates for the new market value to the Federal Reserve, and the Federal Reserve shall immediately pay to the Treasury the difference between the two gold certificates. Now, that was just a sort of prelim to what I'm going to describe in a minute. But what the effect of that would be, if that bill became law, would be that the Treasury, the government, would get about $700 or $800 billion without increasing its debt and without giving up its gold. All it would do, to all intents and purposes, change one bit of worthless paper for another bit of worthless paper at the Federal Reserve, because these gold certificates are not redeemable in gold. They're not redeemable in anything unless the Treasury agrees, and they're perpetual, and they pay no interest. So they're not part of the government debt. So what the government would be, the Treasury would be doing, would be creating $800 billion out of thin air, thanks to the Federal Reserve cooperating in this, which would not increase its debt, wouldn't incur any interest, which they never have to repay to anybody, ever. So they could use that $800 billion to reduce the government debt a little bit for the current year. Obviously, it's not even enough to cover the current year's deficit of $2 trillion, but it's a start. So first of all, I'm going to say, I think this is going to happen for the simple reason that the government cannot afford for it not to happen. They have to take some action to rein in the government. So it has to happen because they can't afford not to. And we obviously did have at one point Secretary Treasurer Scott Bessent saying we want to monetize the assets, and which was perceived at the time as being the assets of the Treasury, because he's Secretary of the Treasury. He's some newspapers have said he's backtracked on that, but actually his words were sort of, he was asked the question, are you going to monetize the gold? Because that's the easiest asset to monetize, because it's the most undervalued and most liquid of all the assets. And he kind of backtracked and said, well, I think at the time we were talking about the sovereign fund, and and he didn't even answer the question. So it wasn't a denial, but it was...
He said in that interview, not yet. He said, we're not thinking about doing it yet. And that's what some people have said, is maybe he let it out of the hat too soon, because now if people know, they front run the government.
So whilst we've had this proposal, not law, that they would revalue the gold at 100% in the Bitcoin bill, funnily enough, I don't know why I put it in the Bitcoin bill, but they did. The proposal's been mooted, but why would they value it at today's price? Why not at tomorrow's price, which is going to be higher, I suppose. So it'd be quite easy to put a different number on gold, so that not only do they cover this year's deficit, which is $2 trillion,
half the deficit,
but they got something left over. They got something left over to cover the next year's deficit and the year after that deficit. So depends how many years out they want to go and how much government bonds they want to repay, because they can't repay all the government bonds because many of these bonds don't mature for another 30 years. So you can only repay what's falling due. So they might want to have enough money to repay what's falling due in the next couple of years. So I did some maths on this, and I thought, well, you need a figure of about, if you're going to do it right, $15,000 per ounce of gold.
Okay.
Why not? Why not? Now, that would mean that they have to make it plausible, they'd have to stand as ready buyers of gold from all comers at 15,000. Of course, at 15,000, if they revalued it tomorrow at 15,000, there would be a lot of people saying, thank you very much, my gold's worth 6 times what it was. I'll have that, please, and I'll reallocate my assets to silver or platinum or some other asset. So what's the advantage of that? There's 2 advantages. One, the Treasury gets in a huge amount of gold.
Yep.
The gold price is underpinned, so it's not going to trade below 15,000. If the Treasury is standing as buyer of the last resort of gold at 15,000, everywhere on the planet, it won't trade below that because you sell it to the Treasury for 15,000. But they will get a lot of gold come in the door.
I know your thesis is right, but would a person would you, Clive, go in and exchange it for 15,000 worthless US dollars, knowing they're going to create a lot more? Well, the average person who might have bought a few might, but I want to challenge. I want to get your thinking through that. Is a smart investor going to go in and hand it in or not at that price?
Well, one of the great things about an asset which is underpinned by a bid is you know you can't lose money.
Okay.
As long as you believe that bid will stay in place. But the other question would be, how much money can you make from here? And I'm quite sure that if they bid 15,000, the gold price on the free market is going to trade above that. But let's say 15,100. But how much higher can it go? It can't really go much higher for a while. It will eventually. But so I've now got a long lag between. I've got an asset which is now safe. On the one point of view, it can't go any lower. But on the other hand, what's my upside is not going to be as much. So would I sell some gold? Yes, I would, but I would definitely keep some too. It's always good to have some assets where you can't lose money.
Yes.
And I wouldn't say you lose money on treasuries, but I don't think you lose money on gold. So I would definitely keep some. Probably I would be thinking at the early stages of selling a third of my gold, and then I'd have to reassess later.
Okay, so you would turn in some of them. Yeah.
Yeah. So the advantage is that the Treasury gets a lot of gold, and it becomes even more so the biggest gold holder in the world, even though lots of people say China really is.
Yes.
But they're not telling us.
Yeah.
But we'll put that to one side. So America gets in the gold. That's great news for America, because now when it goes back to a gold standard, it can do it because it will have enough gold down the line, because a lot of will have come in the door. And the second great news is we have all these foreign nations saying we kind of think we shouldn't be buying any more treasuries, and maybe we kind of like to change our treasuries into gold, but we're not sure if we dare. Well, that would mess them up mightily, because if they do want to change their treasuries into gold, they're going to have to pay 6 times as much as they did before, only get 1/6 of the gold that they got.
Yes.
So it would really, some people would say it benefits the Chinese greatly because they got all this gold they haven't told anyone about. Other people would say it messes them up terribly, because all those treasury bonds that they were thinking of converting gently and slowly into gold, well, they can't get nearly as much gold as they used to. So there's those two conflicting points of view. But I think it would be beneficial to the United States to put the gold price up to and underpin it and bid for it at a higher price than the spot price of where we just had an all-time record today of yesterday, $3,650. Why stop at 3,650? It makes no sense to stop at 4,000 or 5,000. It's got to be higher than that, because even that wouldn't pay off the debt. To pay off the current year's deficit, we'd need a gold price 3 times what it is. So we're talking $10,000. So my figure was $15,000. So at $15,000, you're covering the current year's deficit, a bit of next year's deficit, and you've got some money to repay the maturing treasuries, which mature in the next 6 or 12 months. You get the national debt down a bit. You don't increase it because this deficit has been effectively covered by what you've done, which means there's a shortage of treasuries in the market, which means treasuries get bid up. Interest rates can go down on the treasury market.
Yeah.
And from the government's point of view, it's got a lot of money in its books without having to borrow from the public at large for a year or so. And the national debt will be not as big as it would otherwise be, because we're really in this very, very dangerous area where the national debt really is too big relative to the size of the economy. So I think there's a lot of benefits, and therefore that's why I say they can't not do it. The only question would be at what price. At the market price, it's not enough.
It's not. It's not.
I picked a figure, 6 figures. Some people say, why not 150,000 and pay off the whole national debt? Well, as I say, you can't pay off the whole national debt if it hasn't matured yet. You've got to wait for maturity, and there's no point in having the money up front, because what are you going to do with it? You're just going to spend it.
And those kind of arguments I don't buy also, because obviously at 150,000, you pay off the whole national debt. If an ounce of gold is 150,000, it's not that only the gold goes up, as you might also agree with me. Obviously, everything rises in value because everything is getting debased, right? As opposed to gold. So your silver would be $500 or $1,000 an ounce. Platinum would be more expensive. Your $1 million house could suddenly just cost you $3 or $4 million. Or the rich and the wealthy who had all the gold and had, let's say, 10 ounces converted into $1.5 million, now go and buy more assets. So the rich keep getting richer. So again, there's a happy balance. And I think I've heard Jim Rickards in one of his books say that they don't need to convert it 100% anyways. Back in the days, in the 1940s or 1960s, they backed the currency by about 40% with gold. And even if they get to that, whether it's 30, 40, 50,000, again, the debt's constantly increasing. So that then $15,000, $20,000 an ounce of gold is also constantly increasing. But I think with one of my previous guests also who was in Switzerland, we just said, even if the mark to market, this is again a gimmick. It's an accounting entry and a gimmick. If the mark to market at 3,500, that's 900 billion on 37%, on 37 trillion at about 4 or 5%, that's 1.5 trillion in debt. That's not even 1 year's interest. So it's just an accounting gimmick. And one thing I've heard from somebody else who's a macro analyst says the US might actually not go down the gold revaluation, because they believe, or insider knowledge is, that countries like China, Russia have a lot more gold. And I know I've commented previously where China has asked the insurance companies and banks to hold gold on their balance sheets because you know what's coming. So now assume a theory of chess where America or Trump has been advised that China and Russia have more gold than the US. First of all, we don't even know if the 8,000 something tons are there in sitting there or not. Elon Trump brought it up that we'll audit the Fed and all that kind of stuff. But let's assume it's there. So the conversation is maybe the US should go to Bitcoin because China doesn't have it. By revaluing gold, we're giving more power to the Chinese and the Russian. What are your thoughts on that? Because I know you follow a bit of Bitcoin and stuff as well.
Well, you might have seen yesterday that there is now a consultation process started. They've legislated for it, for a consultation process on the pros and cons of having a Bitcoin reserve in the United States.
Yeah.
And that's been ordered by President Trump. And at last they passed the legislation to start the process of looking at the risks and the rewards and everything else. So it's going down a road which hasn't stopped. In terms of officially putting Bitcoin into reserves. We've also seen, I think it was Kazakhstan yesterday, or was it this week anyway, have said they're going to have a Bitcoin reserve from 2026 onwards. And what other country was it started to study? Was it the Philippines? I can't remember now. Another country in the last week or so has said they're looking at the creation of 10,000 Bitcoins they were going to buy, I think. Let me just see if I could...
Yeah, but if they can just mouse click money out of thin air, then they can mouse click as much as they want and buy Bitcoin, can't they?
Yeah. So, what I think definitely is happening, we're seeing more and more treasuries, the company treasuries, starting to put a little bit of Bitcoin in there. Whether they're doing it because it's what the shareholders get excited about, creates a talking point, or whether they're doing it because they really believe that Bitcoin is the be-all and end-all of the future wealth of the planet. We don't know how they're thinking. Obviously, we do know how some companies like MicroStrategy are thinking, but many of them are just tinkering with it with small amounts.
But I think that policy about MicroStrategy is starting to fail now because the bonds are not being bought anymore. I thought that was something that can't go on forever. And because the MicroStrategy share price was going up, I think other companies tried to imitate, thinking if you just issue bonds to raise capital to buy Bitcoin, our share price will also go up. This is just a gimmick again. And if the average person doesn't get it, what are your views?
I haven't personally studied MicroStrategy, but I did 6 months ago, obviously things have moved on since then, ask ChatGPT that at what level of Bitcoin price would MicroStrategy be in trouble. And it came out with a lot of maths for me. But the ChatGPT's conclusion, which you can't trust, by the way, was it came up with a price which was much lower than many of the estimates in the market. In other words, it seemed a lot safer than what the market is saying. But I wouldn't rely on that one, not even one tiny bit. But I haven't personally studied MicroStrategy, so I have no view on it at all, other than I'm not going to buy it. I did buy it, by the way. I did buy it some years back when when the Bitcoin that it owned was worth more than the per share than the NAV. But then things have changed; it's worth less now. But I'm not going to comment on Bitcoin and MicroStrategy as an investment. I have no idea. I'm not an investor, and I haven't had the time to study it. But what I will say about Bitcoin is there is a use case which is often overlooked, and that is it's something which you can own, which nobody necessarily has to know about or can take off from you if you have to run. So let's say you're a village chief in Africa and you've got your wives and you've got your cattle and you've got your gold, and the neighboring village comes for you. Well, they can't take your Bitcoin because it's 12 words in your head, but they can take the rest. Let's say you happen to be a Russian citizen and there's a photograph out there on the internet of you shaking hands with President Putin. Suddenly you're the best friend of Putin and you find your accounts blocked.
Yeah, frozen.
Let's say you're one of these judges. Was it the European Court of Human Rights or one of these judges who've just been sanctioned by America because they made some judgment against Netanyahu in Israel? All sanctioned. They can't get their money out of the banks. Let's say you're a very wealthy businessman who's built an empire. And I know who I'm thinking of, but I'm not going to say his name, Elon. Sorry, that was me coughing. I wasn't saying the name there. But, you're an extremely wealthy businessman. You know that if your empire accidentally goes down through no fault of your own, they're going to take you for everything you've got. But if you have some Bitcoin, you can move to Dubai and start again, or wherever you can. You can get there. If you're a married man or a married woman and you're in an oppressed relationship or a bad relationship, and let's say a battered woman, and your husband won't let you have your own money and he's very controlling, well, you can secretly go along, at least in my country, to the post office or the train station, buy a Bitcoin card, scratch it off, and you've got it on your phone. But there's no way he can know you're building up this runaway money. So the day you have to run, you can run. But people all around the world pay for their home insurance, even though their house is built for their home fire insurance, even though their house is built of bricks. People are naturally cautious. So there are going to be people who say, I don't know what's going to befall me, what my enemies will do tomorrow, but this might be my parachute, might be my protection. So it does have that use case, but that use case is pretty overwhelmed by the ETFs and the financial use, which is not really Bitcoin at all, because when you buy an ETF, you don't have it. It's not yours. You're just betting on the future price fluctuations. So I think the future price of Bitcoin very much depends on how people behave towards the ETFs and how much they put in and out of the ETFs. But there's the demand to hold it as an emergency parachute is only something which can grow because the network continues to grow. And I can tell you, if the price of Bitcoin goes to zero, I'm having all 21 of them, all 21 million of them.
Just so you can say you own them. See, when I started studying Bitcoin, again, philosophically, I totally understand the concept. Free from government, free from control, which are some of the examples you've just given us. The whole point, I think, is it needs electricity. Russia in a war could have an EMP attack, and there was no electricity in Spain and Portugal recently. So you need to charge your phone and all that stuff, and people need electricity to actually use the Bitcoin. But the other thing is, governments have obviously forced whatever they want the new money to be onto people. When it was gold and then it was cutting the link to gold. So if they have a CBDC in place, why would they let an alternative currency come about? But it is already being used by people, and that's exactly what you're saying. You could run and not have your government take all your funds. But the whole point is, couldn't they just make it illegal? And would you rather go to jail than hold on to your Bitcoin? And especially, it's not just Bitcoin, because it's blockchain. Everyone knows who you are, what you've been spending money on. Couldn't it?
So, which country would make it illegal? I'm just firing a question here. Which country or countries?
Well, right now, Trump is saying, yeah, we're going there. But let's say, for example, in 4 years' time, there's again an election and a Democrat comes in. Let's say Kamala Harris comes up and she says, there's either unrealized capital gains or it's illegal tomorrow. Yeah, that's all. I'm just questioning. I just want your thoughts on that. Could they do that?
Yeah. So then we have the two biggest countries in the world, China and America, who've both made it illegal.
Yeah.
What about the other 500 countries?
Well, I don't know. In India also, you can't. And the whole point is, again, just like we said, gold. They might not make it illegal, but they might tax. I know in New Zealand and Australia, they tax the unrealized capital gains of Bitcoin, but then if it makes a loss, they're not going to give it back there.
The thing is, it all depends on which country you're in.
Yes.
Or which country you can go to.
Yes.
Okay?
Yes.
So if you happen to be in a country where they say, let's say you're Chinese and you have Bitcoin, and you're planning, you might not be able to cash it in with a Chinese company. So I was just hearing some banging. No, I think it's the neighbors hammering in the wall. You might not be able to cash it in through a Chinese Bitcoin exchange, but if you can get out of the country, and you probably can, you can go to another country
and use it,
where you can become a resident, set up a bank account, and use it. So yes, wherever you live, you might find that you are effectively blocked from doing anything with your Bitcoin. That is entirely possible. You might find you're taxed to the nose. You might also find your gold is taxed. You might also find your stock market investments are taxed. Anything is possible. You might find that you're living in India and you're suddenly forbidden from buying American shares because they decided that Indians shouldn't buy American shares, or maybe the Americans will decide Indians can't buy American shares. Who knows? All kinds of things can happen. If you happen to be a Russian and you happen to have a bank account in America, what's happened to it? Well, you know the answer. You can't use it.
Or Americans who had shares in Russian companies and they went to zero during the war in Ukraine.
So yes, there are above average dangers in some countries with Bitcoin.
Okay. Now, thanks for that, Clive. Obviously, on this channel, we don't give financial advice, but let's say, given the government debt we've been talking about and the risk factors there, what's your end game investment thesis? Let's say the governments do default on their debt and bonds get into trouble.
Well, if you have enough wealth to deal with this, you need to be prepared for all kinds of scenarios, both the Goldilocks scenario, the good scenario where the price of everything keeps going up and everybody keeps spending and the economy is great, as well as the terrible scenario where we go into a Great Depression where everybody's so poverty-stricken that they're coming to your front door to take what you've got. So you need to be prepared for all of those scenarios. And what does that mean? It means keeping your assets in more than one jurisdiction if you can afford it. Not everybody can have assets in foreign jurisdictions. Most people cannot, but if you can, having assets in multiple asset classes, which are related to multiple geographic economies. So don't just invest, if you're in America, don't just invest in American securities. There's a whole world out there, assuming you can access it through your broker. You can buy French, German, Italian securities. You can buy Scandinavian, you can buy Chinese, you can buy Hong Kong. If you can access outside the country where you live, go for it. If you could hold gold and silver in physical gold and silver in a place where it's safe, but you can get to it in case of need, that makes a lot of sense. If you want to profit from the price of gold and silver, then it's much better to hold it through an ETF or gold mining stocks. As far as your other assets are concerned, think about your own property. In most societies, it's pretty hard for them to take your property from you, but not in a war situation. So if you happen to be living in a war zone, yes, your property, your real estate might be taken off you, but if you have assets at a foreign bank, no. But if on the other hand, if you're living in a safe country, as it's called today, and you've got your real estate and your bank account, the government might fall into a deep trouble and start to help themselves to your assets to your bank, but they're probably not going to take your house off you.
Okay.
So that's why you be diversified. And if you've got spare money, you don't know what to do it, why not a home extension if you can afford it? Build yourself an extra room or a loft or a greenhouse in the garden or whatever. My point is, don't keep it in cash. That's not the way to go.
Okay, so stay away from cash and bonds because those are the proxies of fiat currency. But something that you said about the property as well, I think if you assume countries like New Zealand, Australia, Canada have a housing bubble, something that a lot of people have been seeing out there is you don't really ever own the property yourself, even if you don't have a home loan and you paid off your mortgage completely, because the council rates keep going up. Your rates go up on the property, and that's happening. Especially, I'll give you a recent example in New Zealand and Australia, where the rates are skyrocketing, going up about 25% year on year in some places, because those councils have taken off too much debt, which was at 2.5%, and the councils are now having to pay that debt back in 7%. So the rates are going up, property prices are coming down. They can take it off you, and some people are. There were stories in New Zealand where people are getting homeless because of that. And I think, again, I won't repeat the person, but in America, somebody has exposed this same thing going on in, I think, 26 or 28 states in America, where it's literally fraud, where the property prices are actually just being riveted up to cover the council's expenses or their debt obligations as well. Don't know if you've heard any of that.
Well, not specifically about New Zealand, but it's not an uncommon thing in countries to put up the property taxes because it's an easy thing to tax. It can't run away.
Exactly.
But what it does do is make people think twice about where they buy property. So to give you an illustration, in the UK, when I was a young man, owning a secondary or other properties to rent out was a great idea. There's no way in a million years I'd want to buy property in the UK now because they've imposed so many taxes on secondary homes, on buy-to-let, and land taxes and things like that, that it just wouldn't make any financial sense. I mean, simple things like not being allowed to deduct mortgage interest for your rent. So all of these things just make it no longer financially attractive. So what's happening is people are saying, why would I build it? Foreigners like me, I'm a foreigner to the UK, I live in Switzerland, are saying, why would I buy property in England, even though I know all about it? Because, and the answer is, it cannot make financial sense if I'm a landlord, a second owner, and people who would be building properties in the UK to buy-to-let flats don't build them because they say there's no demand. The foreigners have all gone.
Yeah, and there's no money to be made.
The only one's got foreign money is the foreigners, and
yeah,
the foreigners have got the money, but they're not coming here. They go somewhere else. They go to Dubai or Florida or wherever they go because they want to, unless they want to have a bounty house, a luxury house in the centre of London for show-off purposes, and they're willing to pay the costs which go with that. But that's not a business. That's not an investment. That's a luxury, like owning a painting on your wall. But the people who do it as a form of saving are probably not doing it, or certainly not doing it in the UK anymore. And so the builders are saying, we can't build these things because there's no buyers.
That's right. There's a cycle for everything, I think. And after the credit cycle over the last 40 years, where bond rates have kind of propped down and now they're on the way up, I don't think property might be a good investment. But again, on this channel, we don't give financial advice. It's just having conversations about, again, understanding different jurisdictions and what they offer and different asset types, what they offer. Hey, coming towards an end, because I'm really appreciative of your time, I kind of do this quickfire round, right? So this is where we get Clive into a corner and we say you can only pick one. And if that is the case, which one would you pick? Again, there's hypotheticals. So just if you could pick only one of these, which one would it be? Bitcoin or gold?
If I'm going to jail for 10 years and I can't touch it, gold.
And gold or silver?
Gold.
Great.
Even though I think silver will do better, but
at some stage, yes, it will.
But you know, it depends on your holding period. If I'm going to jail for 10 years, I can't touch it. I think I go for the gold because I know it's going to be there. I know what it's going to be worth in 10 years.
Exactly.
Silver, you don't know.
Yeah. Would you prefer cash or CBDCs?
Cash.
Great. Would you buy the actual commodity? Let's say we are talking silver, commodity or the mining shares?
Well, in practice, both. But I think the mining shares will give, if you buy the right one,
yeah,
it will give the better return.
Okay. And AI good or bad from your perspective?
At the moment, very good.
Okay. Care to explain?
Well, down the line, there are obviously some dangers, but at the moment, the usefulness of AI is increasing almost at a geometric rate. I mean, there's never a week goes by when I don't find a new AI which has come out, which can do some amazing things which none of the others can do, and it's getting more and more amazing. And even the ones that we all know about, like ChatGPT, which 2 months ago I was saying, you know what, this new ChatGPT 5, forget it. It's not worth it. It's no good. Doesn't do the job well enough. Now I'm saying something's changed. It's amazing. That's how fast things are changing. They go from worst to the best in no time at all. And obviously there's things out there which can do things way better than some others, depending on the task. So when you know your task, you know which AI you want to use, and it's all accelerating. But the danger, of course, is the iRobot situation, which is the Isaac Asimov book in the 1940s or 50s that he wrote. It was a series of articles, but a series of short stories, which turned into a book in the end, and then a movie. But iRobot was a situation where the intelligence become sufficiently intelligent and cognizant and sentient that they start to take over the human race. Now, that is a potential danger, and I would like to think that we as humans will know how to master that, but there will be definitely bad actors.
Yeah, fair enough. And just when you were touching on that artificial intelligence, how it's improving so quickly, something that just came to my mind was also quantum computing, because that's something that people say if quantum computing comes in, it could be a risk to Bitcoin and breaking the code on that. Maybe again, we'll.
Yeah, no, I've asked again. I'm using AI to ask the question, and everyone can do this themselves. The power which would be needed is in the millions of qubits, and there's something like 2,000 qubits at the moment. They're decades away from cracking a Bitcoin code. Long before they've cracked a Bitcoin code, they'll have cracked every bank account on the planet.
Yeah, that's right. That's why maybe they don't want us to have bank accounts, right? And we move to CBDC.
I don't know. So no, I'm not afraid of quantum computing in the slightest. I don't neither for Bitcoin nor anything else. It will have its uses, but I don't see it as having a practical day-to-day use for most purposes in the near future.
Yeah, fair enough.
Next decade, I'm going to say at least.
Thank you for that, Clive. Now we're not going to talk finance or anything anymore. We're only going to talk Clive, as I'd like my audience to get to know Clive a little bit. So a few questions there. Best advice Clive has received from someone else?
Well, that's actually a fantastic question, and it happened to me when I was about 21 years old. I was pretty useless at school. You know, the B stream, that's the second best stream. You only had A and B, so actually it's the worst stream. I like to call it the second best. So I was on the second best stream, and I didn't get much in the way of qualification. I wasn't paying attention in class. I sort of couldn't get it. You know, I got an O level in maths and a kind of half an A level or something in maths, and I think I got an O level. I think I got eight O levels, which was no big deal back then. It wasn't enough to get into university, and I didn't even know what a university was. So my dad paid for me to go to a careers instructor at the school, £5, and he said, "Clive, you're pretty useless. You better get a job. You can't work for the civil service because they only take intelligent people, but you can work for the BBC because you speak good English, or you could go and work in a bank. They take people who are useless, but you've got a maths O level, so you've got a chance." So, you know, I went to work in the bank, and of course, my first job was the filing and polishing the brass knob on the door, as they say in the Gilbert and Sullivan opera. But our bank paid for what's called day release, 1 day a week, to go and study for the banking exams. So I got these day release, and they paid for it, and I had a day off a week, and I took my banking exams, and this is stage one. You've got several stages, but I took stage one after a year and failed. Because, you know, I was kind of like, what for? You know, just turn up at the lessons, but don't do the work. And my manager called me into the office with a colleague. This is getting to the best advice bit. And he said to me, and he said to the colleague, he looked at us and said, Carruthers, the other guy, he said, "Carruthers, glad you passed your exams, well done. Here's your pay rise. You go from grade 1 to grade 2. They turned to me and said, Thompson, sorry you failed your exams. You're back on the filing. And I said, what? What? Well, about a pay rise. He said, so you just gave him one. And he said, Thompson, you are more, bad word, stupid than I thought. I said, well, no, but you didn't tell me. He said, I can't believe what I'm hearing. He said, you're thick as 2 bricks. I said, well, if you told me I'd get a pay rise, I would have passed that exam. He said, you got it, Thompson. You're waking up. I said, well, now I know. I'll take the exam again. I'll pass it next time. He said, no, Thompson, you're on your own. You want to pass those ethic exams? You pay for them. You do it in your spare time. So that's what I did. And it changed my mindset. That was the best advice I ever received. It changed my mindset from thinking that life comes to you to that you have to do something to get your life, make your life the way it wanted to be. This trigger of work hard, get a pay rise was, we were very poor, very, very poor. This trigger of get a pay, I was on 900, by the way, I was on £900 a year from the bank. That's what they paid us back then. What was barely enough to pay for your season ticket. Anyway, so long and short it was, I worked every hour of every day for the next 5 years, including the first year, which was the first exam I'd done. Lunch hour, tea break, on the train home, at home, no TV. We didn't have TV, no telephone, no going out to the pub, no discotheque, no entertainment, nothing. Just work, 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 work. And by the time I passed my exams, it took about 3 years actually. By the time I passed them, I got several distinctions and first prizes, and I came third place in the UK overall. So Suddenly, I knew what I was talking about, because having passed the exams, you know some stuff which you didn't know before. So by some miracle, I knew what I was talking about. And of course, when you know what you're talking about, then the promotions just come easy.
That's right.
And I could move my way up in the career. So that was the best bit of advice I ever had at the age of about 20, or it was 20 or 19 even. And it changed my entire life. So if I repeat that advice to anybody else, don't expect life to come to you. You've got to do something about it to make your life better.
That's perfect. That's perfect, Clive. That was a great example. And obviously you've lived life and you have so many stories to tell, I'm sure. So my next question to you, Clive, is, if you had the chance again, what is it that you would do differently? Can you think of something?
Yeah, I'd risk everything on any idea I had. I mean, throughout my life, I've had these great ideas.
Yeah.
Some of which would have worked, some of which wouldn't, perhaps. I mean, I say perhaps because I never tried them. I don't know. But if I could take my time again, I would, at a young age, I wouldn't go and get a job. I'd say, what can I do on my own without being beholden to some employer, which would make me a ton of money. Now, what I can say today is the number of opportunities are far in excess of what was available to me as a young man. There wasn't a lot you could do, but now with the power of the internet, you can communicate what you're doing and how you're doing it with the entire world. So there are so many opportunities for young people which exist today, but the opportunities which existed in my day of getting a job or working for somebody else don't exist anymore, because as you come out of school, there are no jobs, more or less. Anyone who comes out of school and goes to an office job will find that AI is already there doing the job better than him. So why would you employ a young person today? You won't. Most firms won't do that. I mean, they'll do it for the sake of doing it, but it'll die out. So you've got to do something. But the good news is opportunities are everywhere you look. You just have to dream of an idea and figure it out. And I don't want to give all your readers a long list of ideas, but just I'm going to throw a few out there, just a couple of really, really fast ones for people to think, the way to teach languages. Anybody on the planet can teach languages anywhere on the planet, and there are obviously sites where you can become a teacher. Anyone can become an eBay seller. They can set up an eBay shop anywhere on the planet and say, everyone give us your goods, I'll sell it for you on eBay and give you half the money. And there's countless ideas out there which people can think of, which could be started and then expanded on and make them far more money they'll get than working for somebody else. So all I'm saying is I know young people can't do this because they haven't experienced the world the way I have. So I see ideas they won't see. But ask around, ask the young people. I'd say ask around, ask your friends, ask older people what's missing in this world. What do people want? And when you find some of these things, you might have 100 things that they want that you can't supply, and then you get that 101th, and you can do that. You can, for example, I want someone to cut my grass. Oh, well, you don't want to cut the grass. That's only $5 an hour or whatever it is. But you can employ 25 other people to cut the grass, and you own the lawnmowers, and you pay them all $5. You charge the owner $10.
There's no shortage of ideas if people actually apply themselves. So, and as you said, in today's world, the whole thing is, well, I wouldn't say instant gratification. The today's generation also wants instant gratification. So they want to sometimes know what's going to work before they even try to fail, because you have to fail so many times before you can succeed, right? But you gave some brilliant examples. In your days, it was a lot harder. Today, with artificial intelligence and the internet and the speed of things, there's never been an easier time for people to try whatever they want, because, hey, even if you fail, you can try again so much quicker. Which leads me to...
I want to give a last example. This is something that every person on the planet can do. Now, I'm 68 years old, never worked in programming or databases or computer programming or anything. In theory, I should know nothing about it. I should be too old to do anything with programming. Yet, thanks to the power of artificial intelligence, I have written a lot, and I'm writing more amazing programs which are incredibly useful to me. And because they're useful to me, they would be useful to the entire world if I was to market them and put them on the Apple Store and give them away. Now, I'm not doing that because I want to keep the things I've done for myself, and none of them are what I'd call perfect, but they're pretty damn good. And they're stuff which I've made things which does not exist on the planet, which people want. Certainly I want, and if I wanted, I know other people do. So anybody, if you've got an idea of something you want in terms of a computer application, you can go and get AI to create it for you. And all you have to do is figure out the steps to turn what's been created by AI into a workable program which is sellable via the Apple Store or the Android Store or whatever, or the Google Store, wherever. It's easy today. It's not like you couldn't have done this before we had computers, but now you've got the whole world at your fingertips.
And I'll tell you what, we'll bring you on again. We'll go into this deeper. Hey, Clive, just before we go to the last question, I want to ask you this. Do you have any favorite book that you'd recommend to our listeners?
No, not really. I gave up reading when the internet arrived.
Okay.
but no, not quite. But everybody should read the classic financial books. But one of the classics, which isn't so often talked about, is this particular one, which I'm showing you. It's called What Works on Wall Street by what's the name? James O'Shaughnessy. And this book examines in all kinds of tables, pages of tables, where they examine the performance over a very extended period, 40 or 50 years, of every well-known investment strategy on the planet, like buying low price earning shares, like low price to sales shares, high growth shares, high momentum. There's about 20, 30. But look at the back of the book. There's pages and pages of tables. This one, page 20, chapter 21, is called Ranking the Strategies. So this list here, you see, those are all different strategies. If I pick one in one, it says high margin, all stocks is a strategy. And this one is high 5 years earnings per share gain. This one says low PE stocks. This one says high price to book stocks. So he examines every strategy known to man, studies over a 40 or 50 year period to see which of these strategies produce the best returns. So some underperform the Dow, some outperform the Dow. And if you could take two strategies in combination by taking more than one strategy, it discovers what ones which you could use, combining two strategies, you can produce he did, in the period studied, far better returns than any stock market index on the planet. So I think that's useful to read the book, because you not only get an education in every financial strategy when it comes to picking stocks. And it's useful to know all the stocks. You saw there's about 30 styles there, 20 styles. Useful to know all these styles of investment, but also to understand which ones have been mathematically proven to be successful and which ones were mathematically big underperformers in the past.
That is an excellent recommendation. I've never heard of that book or seen that cover before. I will be sharing it with the guests anyways, because all my interviews have the guest book recommendations on there. So I'll definitely put a link. I don't think I've covered everything with you, Clive, but I think we're going to have to come back and speak to you again. And I'm sure you're going to be a fan favorite. Just for finishing off, where can our audience find more about you? Obviously, I'll be putting the links, but
if you put Clive Thompson into YouTube, you'll find some videos that I do. Some of the videos I've done in the past are completely timeless. So whilst I do try and do daily a news update of the financial markets, if you're not so interested in what's going on today but want to read some timeless stories, I've got a story about the Secret Service hunt for a gold coin, which lasted for 70 years and cost them millions and millions of dollars to hunt down a coin worth $25. I've got a story about back in the 1900s. It was all about the stock market in the background. A man who lost a lot of money in one of the most unusual situations ever seen in the stock market in all of history, and committed suicide by throwing himself into a vat of boiling beer in his own brewery because he was a multi-millionaire, but he couldn't meet the margin call. And there's several stories like that. If you go look at my YouTube channel, Clive Thompson, you'll find those old stories, and they're really good ones. Otherwise, I'm on LinkedIn writing every now and then an article on something to do with finance or equities or Bitcoin or gold or whatever.
We will definitely bring you back because we got a lot of talking to do, Clive, still on the investment thesis about shares and all that kind of stuff. But one last question just for this one. I have a financial consultancy called Success Simplified, so I always end my conversations with this. How does Clive define success?
I think success is all about how you feel. You don't have to be rich. You have to be, you get into a situation where you can feel comfortable in your skin with what you have. So it may be that you've done a very simple and straightforward job throughout your life, but you're happy because the people to whom you provided the service are happy as your customers, and over the years they become your friends, and you have a community around you. That would be a success. But of course, there are people who measure success, and I think that's also a good way to do it if they want to, by the amount of money they've got. They may not. Some of them will have a lot of friends. Some will have a lot of friends because they got a lot of money, and some of them will be secretly hated. But if in their own mind they're happy because they're now a billionaire or a trillionaire, that's success for them, and why not? So what are we looking for? Is it success in your mind, or success measured by the tangible things that you can touch, like a Lamborghini? If I know I don't know anyone's got a yellow Lamborghini, but he'd probably say I'm successful. But can he afford it? Maybe he's on hire purchase. I don't know.
Exactly. No, this was more around what is success to you, Clive, and some of my guests exactly think like you.
For me personally, I'm successful because I'm not charging anybody any money for anything at the moment, and I have people are asking me all kinds of questions because of the fact I'm on YouTube. And because I'm on YouTube, I get a lot of questions. I try and answer as many of them as I can, and I get a lot of praise, a lot of thanks. You only have to look at the comments section under the YouTube to see how much warm comments I was getting. If I wasn't getting that, I would say, why would I do it? I'm doing it because I'm adding something to the world. That's success for me.
You're adding value to other people's lives, and that is it. That's success to you. Yep. So I'll definitely put those links for your LinkedIn and your YouTube channel as well. And obviously then people can reach out through that and the book that you've recommended as well. Clive, one of the other questions I want to ask you, it's not on my list, but it just come to me. I'm sure the audience wants to know, what is the name of the soft toy behind you? Because he's on all your YouTube videos. Does he have a name?
Yes. This is in fact Tigger. Now, Tigger is my financial advisor, because I find that by asking the question to a stuffed toy, I get much better advice than I get from any financial advisor on the planet.
Okay, so his name is Tigger and he's your financial planner. That is great to know. Hey, Clive, I'm sure you haven't been asked that question before, but thanks for sharing it with our audience.
Cheers. You're welcome.
Hey, Clive, I can't thank you enough. You've given me plenty of your time and a lot to the audience to have to think about. Until we bring you back on, I'd like to thank you again for it.
Thanks, Farzin. Thank you very much, and thumbs up for all your listeners.
Thank you.